Your retirement account can drop $80,000 in a single morning, and your monthly income doesn't have to fall by one penny. Sounds impossible? It's not. Here's how it works. The market dives. Two people hold the exact same fund. The first one panics and sells. The second one refills their coffee and does nothing because their paycheck is already on the way. Same crash, same fund. One turned a paper loss into a permanent one. The other didn't lose a thing that matters. The difference wasn't luck, it was the plan. It's built around one fund, SCHD, and one rule: you never sell a single share. By the end, you'll know the exact amount that pays $1,300 a month, why never selling changes everything in a crash, why a bigger yield backfires, and where to hold it so the IRS doesn't take a bite. And there's one number, what this fund's income did in 2020, that surprised even me. That's coming. Quick note, I'm not a financial advisor or a government employee. Everything here is for educational purposes only. For your own situation, always check with a qualified professional. Let's get into it. Here's the whole plan in one sentence. You buy shares of a fund that pays you to own it. You live on what it pays, and you never touch the shares. That's the engine. Most people retire on the wrong number. They watch their balance and it bounces every day. But your balance isn't what pays you. Your shares are. It's like a rental house. You collect the rent no matter what the house is worth that week. The share is the house. The rent is the dividend. So the real asset isn't the dollar amount, it's the share count, because that's what decides the size of your check. Here's the beautiful part. A crash can shrink your balance overnight. It cannot shrink your share count. You still own everyone, and everyone keeps paying. SCHD is the Schwab U.S. Dividend Equity ETF, around since 2011. It holds about 100 solid dividend-paying American companies. The fee is tiny, about 6 cents a year per $100. Before I show you the money, take a guess. To collect $1,300 a month from SCHD at today's yield, how much do you think you'd need invested? 200 grand? $500,000? More? Hold that guess. I'll give you the real number in 2 minutes. So, live on the dividend, never sell. A rule's only worth something if the math works. Let's find out what it takes. The exact number behind $1,300 a month. The number. To do this honestly, I start with the yield. Right now, SCHD pays about 3% a year on what you put in, 3.04 to be exact, over the last 12 months. Prices move, so check it the day you buy. 3% is the working number. Let's do the math out loud. $1,300 a month is $15,600 a year. Divide that by 3% yield, and you get right around $513,000. At today's yield, about $513,000 in SCHD pays you $1,300 a month. That's roughly 14,800 shares at about $34.50 each. How close was your guess? Most people guess low because it's a bigger number than most videos admit. But a plan built on a fantasy isn't a plan. Second thing to be straight about, SCHD doesn't pay monthly. It pays 4 times a year: March, June, September, December. So $1,300 a month is really about $3,900 a quarter. Same total, just 4 checks instead of 12, and December's is usually the biggest. Know that going in. $500,000 is the target, but most of you aren't there, so here's the whole range, and we say every number out loud on this channel. At $250,000, SCHD pays about $7,600 a year, around $630 a month. At $350,000, about $10,600 a year, roughly $887 a month. At $513,000, you hit the target, $1,300 a month. And at $750,000, about $22,800 a year. That's $1,900 a month, all without selling a thing. Find your number. That's your starting paycheck. And I said starting for a reason. But a pile of money isn't the point. What it does in a crash is. Let's run it. Why never selling is the whole game. This is the heart of it. There's a risk in retirement almost nobody talks about until it's too late. Clunky name, sequence of returns risk. Simple idea. While you're working, the order of your good and bad years barely matters. But once you retire and start pulling money out, the order matters enormously. Picture it. You retire with $500,000, a crash knocks it down to $350,000, and you still have to sell shares that year to cover your bills. Those shares are gone. When the market climbs back, you're climbing with fewer shares from a smaller base. You can do everything else right and still run out years early purely from the order the returns came in. And this isn't some rare event. Anyone who retired in early 2000 lived it. Over that whole decade, the S&P 500 basically went nowhere, about 0% a year once you count the two crashes. 10 years of a flat market while you're pulling money out. That's the exact trap we're solving. Now watch what never selling does. Live only on the dividend, never sell, and a crash does something almost magical. Your balance drops, but you sell nothing, so your share count stays the same and your income stays intact. You write it out while your paycheck keeps showing up. Here's the proof. Start with 2022. The S&P 500 fell about 18%. Selling shares that year hurt. SCHD down just 3.2%, and the dividend it paid didn't fall at all. It grew. So an SCHD investor living on dividends got a raise in 2022 while the market was deep in red. But 2020 is the one that got me. COVID hit. The market fell about a third in weeks. If you had to sell shares to live, that's a nightmare. But look at the dividends. Total dividends paid by the S&P 500 that year barely moved. They actually ticked up a little. Prices fell off a cliff, income didn't, and SCHD's payout kept growing. That gap, price crashing while income holds, is the entire argument for this strategy. Now, honesty, dividends aren't bulletproof. In 2008 and 2009, dividends across the market fell about a quarter, driven by the banks. So I won't tell you dividend income can never drop. It can. But here's why SCHD handles it better than most. People think it just grabs the 50 highest yielders. It doesn't. It holds 100 companies, each screened for 10 straight years of rising dividends and real financial strength. And it skips real estate, where a lot of cuts come from. It's chasing durable yield, not the biggest yield. Big difference. And decades of data back that up. A well-known Hartford Funds study going back nearly 50 years found the steady dividend growers held up far better in downturns than the average stock. $10,000 in those growers grew to over $17,000, while the same money in a broad equal weight basket grew to only about $5,000. They fell less and they compounded more. Exactly what you want when you're retired. Quick question before we go on, and I read every one. Last time the market dropped hard, did you sell or sit tight and hold? Drop one word below, sold or held. I'm curious how many of you already have the temperament this plan needs. But why not just buy the 8% fund? Now, before we go deeper, I know what some of you are thinking. If SCHD only pays about 3%, why not just buy a fund paying 8 and hit $1,300 a month on way less money? Fair question. Let's put 3 funds side by side. Let me read it out because the differences are the whole point. SCHD pays about 3% and it's grown that payout around 9% a year. The income is taxed at the low qualified rate. The trade-off? Its value tilt can lag in a hot growth year. VYM pays a little more, close to 3%, but grows slower, also taxed at the low qualified rate. Broader and steadier, just a slower raiser. Then there's the 8% fund, JEPI, and here's what that big headline number hides. Most of that payout isn't really dividends. It's income the fund manufactures by selling off its own upside with options. It's taxed as ordinary income at your higher rate, not the low qualified rate. It caps your growth, and in a strong market, it badly lags a simple index. So look at the real trade. For a plan you'll hold 20 or 30 years and never sell, that 8% means a heavier tax bill and most of your growth gone just for a bigger number today. Durable and growing beats big and shrinking almost every time. The objection smart investors raise. So a bigger yield isn't the shortcut it looks like, but there's a deeper objection to the never sell idea, and it's the smartest one in the room. Let's take it head on. Here's the objection, and if you've read anything about investing, you've heard it.
A dividend isn't free money. When a company pays you $1, its stock drops by $1. So a dividend is really just selling $1 of shares for you. Why not sell shares yourself when you need cash and skip the fund entirely? And you know what? On the pure math, that's correct. Selling a few shares to make your own paycheck, a homemade dividend, lands you in a similar spot on a spreadsheet. I won't pretend that math is wrong. So why still build it this way? 2 reasons the spreadsheet leaves out. Reason 1 is human. When the market's down 30% and every headline is screaming, the plan that says sell shares now to eat is the hardest one on earth to follow. That's when scared people sell everything and lock in the damage. The plan that says do nothing, your check's already coming, that one you can stick to. A strategy you'll abandon at the worst moment isn't a strategy. Reason 2 is being forced. The dividend investor is never forced to sell at a bad price. The dividend just arrives. The share seller has to choose to sell, and in a deep crash might be forced to dump more shares at lower prices just to pay the bills. That's the sequence risk again. Never selling sidesteps it by design. So here's the myth. Dividends are magic free money that beats everything. Not true. Here's the truth. They hand you income you can live on without being forced to sell at the wrong time. That's not a trick. It's a seatbelt. So which camp are you in? The sell shares when I need them camp or the never sell camp? Either one's fair, but if you're near retirement, be honest about which plan you could actually follow on the market's scariest day, because that's the day that decides everything. Now, one more piece, and it's got nothing to do with the fund. You can pick the perfect fund and still hand a chunk of this income to the IRS for no reason, just by holding it in the wrong account. Let's fix that. The one account decision that protects your income. This is the part to send a friend who's about to retire. Almost nobody gets told this, and it's worth real money. Good news first, SCHD's dividends are what the IRS calls qualified, the good kind, taxed at the low long-term rates, not the higher rates your paycheck got hit with. And here's how good. In 2026, a married couple gets a standard deduction of $32,200. On top of that, qualified dividends are taxed at 0%, literally zero, up to almost $99,000 of taxable income. Stack those, and a couple under 65 living mostly on these dividends can collect around $130,000 a year and owe zero federal income tax. Zero.
Under today's rules, you can live on this income and pay nothing in federal income tax. Not a loophole. Most retirees have no idea that window's even open. But, and you knew a but was coming, that same income can quietly cause 3 problems if you're not watching. Here are the traps and the one move that handles them. Trap 1. Before Medicare. Retire before 65, buy insurance through the marketplace, and your premiums depend on your income, and dividends count. As of 2026, the extra help is tightened up, and crossing a certain income line can cost you thousands in lost subsidies. Trap 2. ARMA. It's a surcharge on Medicare once you turn 65. Cross a line and it costs more, about $2,300 a year extra for a couple at the first step. And it looks back 2 years, so today's income sets your premium 2 years out. Trap 3. The Social Security tax torpedo. As your other income climbs, more of your Social Security check becomes taxable, and dividends can push you into that zone. So, do these traps make SCHD a bad fund? Not even close. Where you hold it matters as much as whether you hold it. Here's the move. Retiring before 65 and juggling those insurance subsidies? The best home for SCHD is a Roth IRA. Inside a Roth, these dividends are invisible to all 3 traps. They don't count against your subsidy, they don't feed ARMA, and they don't touch your Social Security math. The income is just yours. Got room under that 0% bracket? A regular taxable account can be beautiful. You might pay nothing on the dividends, and the money stays fully accessible. The one to watch is a traditional IRA. You can hold it there and the dividends grow shielded for now, but when you pull the money out, that low-taxed qualified dividend becomes regular, higher-taxed income. You give up the fund's best feature, so avoid burying SCHD in a traditional IRA if you can. Simple version, Roth if you're bridging to Medicare, taxable if you have room in the 0 bracket, go easy on the traditional IRA. Get that one call right and you protect years of income. If you're not there yet,
So the fund's durable, the plan survives crashes, and it's tax smart. But one group's left, the people not sitting at 500,000 yet. If that's you, this last part matters most, because this plan works just as well on the way up. Here's the piece that does the heavy lifting and why I said starting paycheck. SCHD doesn't just pay you, it gives raises. Over its life, it's grown its dividend by roughly 11% a year on average. I'll be straight, it's slowed lately, closer to 9% a year over the last 5 years. But even 9% means the income grows on its own, faster than inflation, without you adding a dollar. Let me think that through. Say you're getting $887 a month today on $350,000. If the dividend keeps growing at a modest pace, that same pile of shares with no new money pays more next year. Your share count never changed, your paycheck grew anyway, a raise you didn't have to work for. So while you're working, reinvest every dividend automatically. Each dividend buys more shares, those shares pay their own dividends, and it snowballs. Then when you retire and need income, flip that switch off and take the checks as cash. You spent years growing the share count, now those shares pay you. How long to build to that 500,000? Honestly, it depends on how much you add and what the market does, so I won't hand you a fake number. But here's the encouraging part. You're not doing it alone. The dividend growth does part of the work, lifting your income year after year while your reinvested shares stack up. For most people, it's a steady, decade-plus build, not an overnight one. And every share you buy today pays you for the rest of your life. That's the whole journey. Build the share count while you work, live on what those shares pay when you stop, and never, ever sell the shares that pay you. Which brings me to the one line to take from this. The market sets your balance, you set your share count, and your share count is what sends the check. Screenshot that if it helped, because once you stop retiring on a scary bouncing balance and start retiring on a share count that pays you, a crash stops being an emergency and starts being background noise. Alright, if someone you love is heading into retirement and still thinks they'll have to sell their investments in a downturn to survive, send them this video right now. It might be the thing that lets them sleep through the next crash. And I want to hear from you. What's your SCHD number? The balance you're working toward or the one you've hit? Drop it below. I read every one. If you're building real income from your investments and want to stay ahead of the changes most people never see coming, subscribe to Dividend Hustle. It's what we do here every week.